For the past 6 years, smaller companies have been the market's chronic losers. Large-cap tech absorbed almost all available capital, leaving small-cap stocks entirely eclipsed. But this year, the math flipped. Small caps are currently outperforming big caps by a staggering 8.5%. Tracking where these billions of dollars flow tells us exactly how the broader economy is actively rebalancing itself. Several identifiable factors explain this rotation, but as we look closer at the data, some of the numbers start breaking established financial logic. Curious. Deciphering this anomaly is the only way to know if we are looking at a temporary glitch or a completely different economic cycle. This side-by-side breakdown of the S&P 500 and S&P 600 indices highlights the sector mix. The best performing sector is energy. The S&P 600 holds a 6.5% weight in energy, compared to only 3.5% for the larger S&P 500. Next, look at tech allocations. Information technology makes up a third of the large-cap index, but only 12% of the smaller S&P 600. Recent AI software panics caused tech to drop, dragging the heavily weighted S&P 500 down. Meanwhile, smaller energy companies are highly leveraged to the physical price of oil. Because little companies benefit most in cyclical expansions, small caps are up 41% here, compared to big caps 29%. While big cap tech performance is deep in the red, small cap tech is actually having a very profitable year. You might assume the Magnificent Seven are dragging down the large cap average. Even if you remove those specific giants, small caps are still outperforming the rest. Sector weighting logic cannot explain this. The fact that small tech companies are beating large tech companies proves an entirely different current is pushing these numbers. To see what that current is, we look at this grid based on the MSCI indices, sorting the market by size on one axis and by growth versus value on the other. In this setup, companies that are fundamentally cheap, value stocks, should beat growth stocks. Because small cap indices are de facto value indices, the small value quadrant is the logical winner. Yet the data shows something completely different. Within the winning small caps, growth is leading the charge, completely ignoring the structural logic of the matrix. The market is operating against its own environment. Investors are buying up small growth stocks in an economic landscape practically designed to penalize them. Since traditional financial models have failed to explain this anomaly, analysts are now looking at one single broad macro theory. For years, big-cap U.S. growth stocks absorbed massive amounts of capital, and their valuations overshot. Now, those dollars are violently reverting to the mean. But expensive stocks do not drop simply because they are expensive. A specific catalyst is required to trigger a sell-off, and right now, no one agrees on what that catalyst actually is. The financial data is moving much faster than our ability to explain it. This proves the market often tells you exactly what is happening, long before it reveals why.